Hey, soldiers, the Fed just raised rates again. Jerome Powell also came out and said, hey, look, I don't know what's going on. I don't know where this economy is going. I've lost control. But he did have one prediction.
Prediction?
Yes, prediction.
Pain.
All right, let's talk about what's going on here. And let's also get into how small businesses can thrive this. Okay, you got a small business out there, you just started, you've been in operation with it for years maybe. Either way, you really need to concentrate on battening down the hatches and going through this storm and coming out on the other end of it in good stead. So we're going to get into all of that. First, let's take a look at what occurred in terms of the latest rate hike, which was not a surprise. Everybody forecasted a 50 basis point increase in the rate that Jerome Powell controls over at the Fed. And that's exactly what he did. He raised rates, and the Fed funds rate is now at 4.5%. So, look, it's there. It's going higher. Okay, let's just brace ourselves. Let's just be adults and understand that this is going higher. And here's why. The last time rates were this high was in 2007. That's bad news for an economy addicted to easy money, of course. Now, why is this happening? Well, because, look, we got to figure out what we want more. Do we want an environment with low inflation? And, do we want to go through what's necessary to get back there? Or do we want an environment where prices just continue to rise? Listen, I was at the grocery store the other day, and a dozen of eggs was like $5. Now, I'm going to be straight up with you. I usually don't really notice the prices, and that's not because, I'm on the level of King Charles or anything like that. No, it's because it's just my wife and I, all right? And since we don't have kids, we like to get into cooking and recipes and things like that. So where we would be sending a kid to college, saving up to do that and feeding them and clothing them, we, take some of our money and enjoy life by cooking, culinary, experiences. Now, I usually do not notice the price, but when I saw that, I said to myself, I don't remember eggs being this expensive. My instinct on that was right, because when you look at the Bureau of Labor Statistics, food inflation is up 11% this year. Now, that's for all food items. Some, of course, are up higher than that, but the average is about 11% for food. So do we want an environment where we're going to continue to see these hikes in necessities like food? Because there are a lot of people out there who are suffering as a result of that, especially senior citizens on a fixed income. So, you got to pick your poison here. And in order to get back to a low interest rate environment, which is not only good for going into the store and, being able to purchase groceries affordably, it's also good from the standpoint of you having money to purchase assets. Okay. Right now, a lot of Americans are finding it more and more challenging to do that. But I encourage you to continue, even if you may need, you were putting away $200 a week. Okay, for your asset purchases and, building up your wealth. Well, maybe you can only do 175 or 150, but do it. All right, so the message, the official message that came out from the FOMC, Federal Open Markets Committee, was nearly identical to the November message. And we went over the November message in detail last month. The committee only made some slight changes to the verbiage describing the impact of course, the Russia-Ukraine war on the global economy. They've always got to have some excuse. But you and I both know that the bulk of this is coming out of the profligate spending, all the money that Congress threw out on the street when we had the events of 2020. The messaging relating to the future trajectory of monetary policy was unchanged. The statement said the committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We got a long way to go before we get back to 2% inflation. Would 2% be nice? Oh, sure, absolutely it would. But if that's the goal, which is this is the second month that he being Jerome Powell, has emphasized this, then the tool in his toolbox to get us there is increasing these rates. So that right there is telling you straight up, okay, in a manner of speaking, that you can expect to continue to see these rate hikes. It also said the committee will continue to take into account cumulative tightening and the lags with which monetary policy affects economic activity and inflation. So right there, they're saying, look, when we raise rates, it's not immediate in terms of its effect on slowing down the economy. So we recognize that. We realize that. But we will continue to monitor the situation. We're not ruling out continuing to raise those rates. Now, here's a money shot. As he did after the November meeting, Federal Reserve Chairman Jerome Powell sounded a hawkish tone. He said, quote, "We have more work to do," unquote, and emphasized that rates would move higher and stay higher longer than originally anticipated. Okay, emphasize that. He went on to say, "My view and my colleagues' view is that this will take some time. We have a long ways to go to get back to price stability," unquote. That is your Federal Reserve Chairman Jerome Powell. Powell also dismissed the notion that the central bank might cut rates next year. You hear a lot of people say, oh, he's going to pivot. He's going to pivot. He's going to cut rates. Powell claimed that the Fed has now pushed interest rates into restrictive territory. But it's unclear how he arrived at that conclusion. With CPI still, Consumer Price Index, still over 7%, real interest rates remain negative. That means the Fed continues to run an accommodative monetary policy. Now, look, we throw this chart up, and you can see that what Jerome Powell is doing is nothing compared to what Paul Volcker did back in the 80s. I mean, Paul Volcker took inflation by the horns and wrestled it down on the ground, tied a rope around it like one of those rodeo stars you see down in Texas. And he defeated it. Some are saying this piecemeal approach by the Fed, what we've seen, little half-point raise here, half-point hike there, may not be aggressive enough. And to the extent that the Fed agrees, we might be in for, some stronger hikes. Yes, the Fed has tightened significantly, but it is still behind the inflation curve. In effect, it has slowed the flow of gasoline into the inflationary fire, but it continues to pour gasoline on the inflationary fire. When asked about the pain of inflation, Powell said Americans would suffer worse pain if the central bank failed to act and let inflation run out of control. In a tweet, Peter Schiff said, "That is a moot point." Here's the tweet. Powell said that the worst pain for Americans would result if the Fed failed to act and let inflation run out of control. Inflation is already out of control, and the time for the Fed to have acted to prevent it without triggering a severe financial crisis has long since passed. So what Schiff is saying is, look, we're looking at hindsight, but going forward, if the Fed's going to do what it needs to do, we're looking at a significant financial crisis. And that is what Citibank had forecast. We did the video just yesterday talking about how Citibank said that we were in for a severe recession in 2023. One of the reasons we're probably going to see that severe market downturn, a more severe and lasting recession, is because there's a lot of denial out there. Americans are just addicted to the easy money that we've had for the better part of a generation at this point. The U.S. economy is addicted to easy money. It is addicted to artificially low interest rates and quantitative easing. You can't take an addict's drug away without sending him into withdrawal. Now, look, this is an aspect that we see in one particular sector of the economy right now, real estate. You've got sellers, home sellers, who are reluctant to lower their prices, to make repairs to the property, to do the things they did not have to do when it was a seller's market because interest rates were so low that you had every Tom, Dick, and Harry trying to, out there competing to get a home. You had low interest rates. You had a lot of money on the street. The job situation was, there was a lot of, and there still is, a lot of competition in the job market. So wages were good, but inflation wasn't as high as it is, separating the wage from inflation and creating that huge wage gap. So the sellers don't want to moderate, and the buyers are out there acting like they are entitled to these extremely low interest rates that we've seen over the past few years. Now, if you look at, this is the 30-year fixed mortgage average in the United States. We're going back to April of 1971. You look all the way back to May of 2000. This is literally a generation ago. May of 2000 is the last point at which these rates were significantly higher than they are right now. Now, of course, the last time they were, let's see, we're at the mortgage rate right about now is somewhere in the neighborhood of 6.33%. So yeah, the last time we saw that was looks like 2006 to be precise. Again in 2007. So you had an environment for 20 years where interest rates were relatively low compared to where they had been prior to that. And you've got a generation of people who do not believe that they got to pay 5% on a mortgage. And this is an artificial belief, as you can see from, the chart. And let's not even talk about the 80s when Volcker was out there being aggressive with his interest rate and mortgages were going for 18%. Okay. So there is an addiction, a true addiction to this easy money. And I don't know what the methadone is, okay, for this. I don't know what the Narcan is for this, but people better get over it because according to what Jerome Powell is saying, we're going to be in this situation for quite some time. Now, listen, if you are a small business owner, a couple of things that we need to talk about. First of all, November retail sales fell in the biggest drop in nearly a year. So maybe we are seeing that delayed reaction from these rates increasing to people, tightening up the old wallets. Shoppers slowed spending on autos, furniture, and other goods as inflation cooled. Yes, inflation is cooling, but money is becoming more expensive. Interest rates are rising. U.S. retail sales fell sharply in November as the holiday shopping season got underway, posting their biggest drop in nearly a year as inflation cooled. Sales at U.S. retail stores, online sellers, and restaurants fell by a seasonally adjusted 0.6% in November from the previous month. The Commerce Department said on Thursday, that would have been the 15th of December, 2022. That was a slowdown from October's robust 1.3% increase. Okay, so the message is being driven home. Things are becoming more and more uncertain. As I told you, the Fed itself has said that, hell, we don't even know what to expect. Powell said recently, I don't think anyone knows whether we're going to have a recession or not. And if we do, whether it's going to be a deep one or not. It's not knowable. So he doesn't know, doesn't have any clue. You know what it is? He doesn't want to be definitive anymore because he got burned when he said that, well, we're not going to have inflation. He said that so many times. And I guess the guy's like, look, you won't catch me on camera being definitive anymore. I'm going to be ambiguous. That way, whatever happens, I'll be right. All right. So we've got all those factors that have resulted in, the environment that we're in right now. Now, if you are a small business, what do you need to do? Well, for starters, you need to focus on your cash reserves. We talked about it ad nauseum, the fact that cash is going to be something that you're going to need in order to address these issues. If you don't have a large amount of cash on hand in your business, it might be smart to figure out if you can find it. Cash reserves are something that are generally built with foresight and planning for the future, but that doesn't mean that you can't build them up if you're feeling weak in your cash reserve. Now, why do you need cash reserves in your business? Well, one of the reasons for that is because as credit tightens, as money becomes more expensive, there are some things that you want to continue to do in your business without driving up expenses in this rising interest rate environment, in an environment where economic activity is slowing. The last thing you want to do, of course, is to have to increase in expenses. So you got to get in there, look at your current invoicing and try to find any outstanding invoices that clients might be late with. Go ahead, collect on those. Follow up with any clients that might be struggling to pay their invoices. Try to work out a payment plan with them. Do whatever you can to ensure any money that you are owed will make it into your accounts as soon as possible, and do everything you can to hold on to that money. All right, so the focus here is to increase your runway and plan for the worst. Of course, this depends on how fundamental your goods and services are for your clients. If you're out there selling some discretionary item, we talked about it on yesterday, you might want to consider a complementary item that is more of a necessity. Okay, now in our arrangement, sure, people need housing, but in order to buy a house, there are some steps you have to take. You got to, have your credit has to be halfway decent in most cases. You have to have some sort of money on hand for closing costs and down payments and all that. So it's a bigger get than rents. So people say, yeah, I need shelter, but for expediency's sake, I can go ahead and rent for now. So while shelter is a necessity, buying a home isn't necessarily. So on the one part of our arrangement here in our companies, sure, that might be something that people put off until later on down the road. But in terms of their financial services, okay, they still need to worry about putting money away. They might be putting less away, but they still need to worry about putting money away for retirement. They still need to worry about insuring themselves. God forbid something happened to you and you're not able to provide that income for your family anymore. So that's the pivot that we have when the real estate industry starts to wane in terms of its activity. So you definitely want to go out there and find a product or service that is complementary to what you do, especially if your main product or service is more discretionary in nature. So that kind of leads into number 2, find your most profitable activities and double down on them. The other thing that that allows us to do, it allows us to make every client more valuable. Okay, so take Frito-Lay, for example. They've got snack foods and they've got beverages. All right, so, who's going to walk into a 7-Eleven and just buy a bag of potato chips? Okay, very few people. So the chances of someone buying a Lay's potato chip, a bag of Lay's potato chips, and then also buying a Frito-Lay beverage are pretty high, right? So Frito-Lay has, in effect, made each client more valuable. And I personally feel that, I want to be able to provide our clients with more choice. We know we're going to treat them right, okay? They're going to get high quality from us. So it's a symbiotic relationship that really, at the risk of being redundant, benefits us both tremendously. Okay, for all you small businesses out there, the last one is emphasize delivery, retention, and referrals. What do I mean by that? Happy customers create more business. Repeat and referral business is extremely important in a recession. Ensuring that your clients are happy is vital in any economy, but especially in a recession when money gets tight. Everyone looks for ways to cut expenses. A recession is a great time to increase touch points with your clients in order to ensure client satisfaction. Sometimes when the economy changes, so do your clients' needs. Utilizing this opportunity to discover any additional or change in the pain points of your customer can lead to more profit, satisfaction, and referrals. And those referrals are going to really be important because you're going to have to also work on one of the benefits of a recession, and that is expanding your market share. Now, how do you do that? Well, let's go back to the realtor, for example, for a minute, just because it's something I'm familiar with, but you can apply this to a lot of businesses. In recessionary times, unfortunately, a lot of people go out of business. This provides those who stay in business the opportunity to increase their market share, to bring in new clients. Just because you went out of business with the kebab restaurant doesn't mean that the people that were coming there don't want kebabs. No, they still do. You weren't able to attract enough of them in a recession because maybe they were purchasing more food from the grocery store. But if you are the surviving kebab shop, surviving realtor, surviving, clothing store, furniture store, whatever, then you're going to be able to attract those people who still want that product, still want that service, but the place they were going is now out of business and they can't get it from there. So that's another avenue. Guys, go out there and decrease those expenses. Okay, this is the business equivalent of taking in the sale. Okay, making sure all hatches are closed. All right, storm clouds, it's right there. Do what must be done. Now look, I want you to check out this video on our channel. BlackRock, BlackRock, they're out there, major investment company. They're actually warning that the mother of all recessions is on its way in 2023. We talked a lot about interest rates today. See what this private corporation has to say with regard to the coming recession, the coming storm. Guys, I'll talk to you soon.